that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market, and it's a highly uncertain estimate, and I mean, there's really we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, and because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment. You see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
You know, it's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. You know, the question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and you know, we're certainly trying to find it.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate
Leadership. So I think that's what you think about. You know, what can we do to make sure? But again, that's not for me to answer today.
Do you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, you know, this review's going on, and you know, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. You know, it just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, you know, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit
okay.
were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, you know, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, you know, what will be the extent of it, and what will be the duration of it, and then, you know, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, you know, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, you know, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and you know, so that's all I have to say. So, thank you very much.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk with a heightened awareness